I like the Bridge on the River Kwai because of there were a lot of lessons in that. Plus, it was enormously fascinating.
Warren Buffett, How Beginners Should Invest. 3 Simple Rules. Warren Buffett is one of the most successful investors in the world. He shares his advice for beginners on how to invest. According to Buffett, beginners should follow 3 simple rules. Invest in a diversified portfolio, stay patient, and don't try to time the market. So let's try to dig first into the roots of Warren Buffett and his investment mindset. Hello everyone, welcome back to Business Opportunities. Today we are going to talk about the 3 simple but mind-blowing rules of investing for beginners according to Warren Buffett. But before we begin, make sure you subscribe to our channel and click the bell icon so you don't miss out on any of our amazing videos. So let's begin.
And the second thing, which I'll get a certain criticism for not living it, but
Warren Buffett's rules for investing are more than just rules. They are also principles that good businesses follow. So it's not wrong to say that Warren Buffett is not only a great investor, but also a very smart businessman. Warren Buffett went to Columbia Business School, where he learned how to invest. At that school, his teacher was the famous value investor Benjamin Graham. In the 1950s, Warren Buffett went to Columbia Business School to learn about investing from Benjamin Graham. Buffett was only 21 at the time. Buffett was still young, and Benjamin Graham was the perfect investment guru for him. The 2018 annual meeting of Berkshire Hathaway, which was led by Chair Warren Buffett, has renewed focus on the master investors' methods for choosing winning stocks, ranging from Apple Inc. to Coca-Cola Inc. to Delta Airlines Inc., while simultaneously expecting the forthcoming actions of the Oracle of Omaha. CNBC has produced a report in which the most recent and in-depth study of Buffett's strategy is presented. It analyzed decades worth of Buffett's public statements and came up with 3 fundamental suggestions for purchasing stocks. These are recommendations that Buffett has made in public, including at yearly conferences, such as the one that took place in Omaha, Nebraska. These are to invest within your circle of expertise, think like a business owner when purchasing stocks, and buy at low prices to offer a margin of safety for your investments. CNBC's calculations show that shares of Warren Buffett's Berkshire Hathaway have generated an average annual return of 20.9% from 1965 through 2017, which is more than double the return of 9.9% that the S&P 500 index has generated. The result of this, they point out, is that the cumulative gain for Berkshire Hathaway stock was 155 times bigger than that for the S&P 500 over the course of that time period. According to Lawrence Myers, a portfolio manager and CEO of consumer financing company PDL Capital, as per a story published in Yahoo Finance, these stocks have been the largest long-term winners in Berkshire Hathaway stock portfolio over the last 10 years. Apple at plus 665%, Visa at plus 556%, MasterCard at plus 583%, and Delta Airlines at plus 550%. Here are Warren Buffett's 3 simple rules of investing for beginners. Number 1 is circle of competency. When it comes to purchasing stocks, Buffett is of the opinion that investors should not go too far from their comfort zone. This is one of the most important rules. According to CNBC, he suggests that investors should make sure they have a comprehensive understanding of how a company functions, how it generates revenue, and the long-term viability of both its business model and its profitability before purchasing the company's stock. During the 1999 Berkshire annual meeting, he referred to this as working within what I call your circle of competency, and CNBC reported that he used this phrase. Analysts at Credit Suisse Group, AG, recently made their own attempt to identify prospective future purchases by Buffett, and one of the things they found was that he loves businesses that are simple and straightforward to grasp. Buffett has passed up on a number of profitable investments in the technology industry, with the notable exception of Apple, which manufactures smartphones and personal computers, for the simple reason that he did not feel that he had sufficient expertise to evaluate the business models being offered by these companies. Berkshire Hathaway has just recently raised the size of its already substantial holding in Apple, but the company was a relative latecomer to the stock due to Warren Buffett's caution to venture into uncharted territory. Number 2 is you're buying a business. When Buffett was a college student in 1949, he read The Intelligent Investor, the landmark book written by value investing pioneer Benjamin Graham. Many people think of this book as the Bible of value investing. This book provided Buffett with a second important realization that year. According to CNBC, Warren Buffett stated the following during the annual meeting of Berkshire Hathaway in the year 2002. You're not looking at things that wiggle up and down on charts or that people send you little missives on. Saying purchase this because it's going up next week, or it's going to split, or the dividend's going to get increased, or whatever. Instead, you're buying a business. According to CNBC, the most important idea that Graham presents in his book is that purchasing stock transforms you into a part owner of a company. As a part owner, you do not need to be concerned about short-term changes in stock prices. Indeed, Buffett is of the opinion that short-term price changes, which are more commonly referred to as volatility in today's market, constitute transient noise that long-term investors should disregard. Number 3 is margin of safety. The third piece of advice that Buffett has adopted from Graham is to purchase equities that have a big margin of safety. These are investments that are being offered for sale at a price that is significantly lower than their true worth. According to CNBC, if you invest using the strategy of bargain hunting, you should be able to limit your potential losses in the event that your estimation of an asset's intrinsic value is incorrect, or if unforeseen events depress the once promising prospects of a company. Naturally, arriving at an accurate estimate of an asset's intrinsic value is not something that can be easily reduced to a set of formulas. However, the Graham method, which is the one that Buffett uses, is predicated on conducting an in-depth fundamental analysis of the data that is relevant to a company, its industry, and the economy as a whole. Buffett is distinguished by his remarkable ability to make astute evaluations of value over a span of decades. Here's one more piece of advice that Warren Buffett believes is best for an average investor. What did Warren Buffett mean when he said, "Never look at a headline"? For the average investor, who lacks Buffett's analytical prowess and keen eye, he believes that the safest bet may be to simply cast your lot with the long-term prospects for the U.S. economy and the U.S. stock market. The best single thing you could have done on March 11th, 1942, when I bought my first stock, bought a stock index fund and never look at a headline, as if you had bought a farm, he said, noting that a theoretical investment of $10,000 in an index fund back then would be worth more than $51 million today, which include reinvested dividends. Let's take a look at Buffett's worst picks and what we can understand from it. Buffett has, without a doubt, put his money into a number of companies that have failed. According to Lawrence Myers, Buffett's investments in Teva Pharmaceutical Industries Limited, Bank of America Corp., and USG Corp., a company that specializes in the production of building materials, performed the poorest during the course of those 10 years. Over the same time span, the S&P 500 index has seen a gain of 77%. However, Buffett's remarkable overall record demonstrates how beneficial Buffett's 3 best investment rules are to investors. Warren Buffett won't buy stock in a company unless it is very strong and the price is low. During this time, even high-quality business stock can be bought at a huge discount. In the current bear market, investors are in a similar situation or have the same chance. Stocks of good companies are trading at prices that are lower than normal. And that's it for today's video. We sincerely hope you enjoyed it. If you did, please give it a like and share with your friends and family. Let us know if you have any questions or comments in the section below. And please don't forget to subscribe to our YouTube channel where you'll see more of our incredible videos. We look forward to seeing you in the next one, and thanks for watching.